Hey guys, Btwice here. Today is Sunday, December 19th. I hope everybody is having a really good weekend. Obviously, here in about the next 30 minutes or so, we're about to be kicking off futures. So, another exciting week is about to kick off. I did not have a time this weekend to do a video on ES or NQ or anything like that. They are all up in the Discord. I will drop a link down in the description of this video. So, join if you would like to see my updates and my trade ideas. It is free. With all that being said, I had a member of the Discord DM me. They wanted to see how I get my supports and resistances, how I get my levels. It is pretty complex. It probably would take multiple videos to go over all of it. So I'm going to touch base on what I think is important and go from what is the most basic concept to what is a little bit more complex in exactly what I do in my trading. So, with all that being said, let's jump this thing off. The first thing I want to go over for supports and resistances is the bare minimum of what you need to know. Anybody watching this video, most of you guys will probably already know this, so bear with me. But basically, when you're looking at a chart, I'm looking at AMD, and the reason I'm looking at AMD is this is one of the trades I took this week that I announced in the Discord when I said it was about to break out the bull flag. Ultimately, had a massive run up to 148 before crashing back down. It was a very, very choppy week, but it's a good example of when you know these supports and resistances and you know indicators, how you can use them to your advantage. And when you're using chart patterns, it all kind of rolls up. And that's why I was saying it would take many, many videos. You could read multiple books on this before you get all this knowledge. So let's just jump into the bare bones of it. So looking at supports and resistance, the basic thing you need to know is like, look at these pivots, right? So like this is, I'm calling a wave one, pull back for wave two. So these are pivots. So it's pretty obvious to say, hey, like, sorry, this is supposed to be straight. That could be a support. Go a little bit higher, you'd say, hey, like this support, this is a support. So pretty much anywhere you have these pivots, whether it's a peak or a bottom where we caught support, it's considered a support, and when you're below it, it's considered a resistance. So up here at all-time highs, we could draw a straight line across, and we'd say that's a resistance. We could say this peak is a resistance. We'd say this peak is a resistance. Now, the strength of a support or resistance depends on how many times something has touched it and bounced off of it. So like this one I drew right here, obviously we kind of struggled at it, but we broke above it. We came down, we used it as support. Obviously, we rallied, and then we come down, we touch it here, we touch it here. We kind of struggled to get above it here off this one candle right here. Looks like a hanging man. Ultimately, we got above it when we were going to break out. We came down, touched it again. So you could say, relatively speaking, this is a pretty decent support. So if AMD was to fall from its grace of where it's sitting at right now, 138, it might be a decent spot to try to buy the dip at this 134 range, just because you see we bounced off it a couple times. So when you're looking at the hourly chart, if you start to see some candles that look like they want reversal, and you start to see the moving averages look like they could possibly be having a bullish cross, or maybe your indicators are starting to curl, whether you're looking at MACD, maybe you've got some bullish divergence on RSI. If you're seeing those things and you've got this line drawn on your chart right here, you could say, hey man, there's a good chance that I'm going to get a pop here. So maybe I'll grab a weekly call on this thing and I'll just look to flip it off the next rally for the next pivot. So that's basically the gist of supports and resistance. It's pretty basic. You can just look for spots that we've either struggled to get past or that we've used as we've come back down and then turned higher from it. So we'll delete these two off. So that's pretty much the most basic part of supports and resistance. It's basically just a line. Now, with that being said, there's linear charts and there's log charts. So obviously you're going to have different support zones depending on what you're looking at. Not if you're looking at a straight line across, but when you're looking at trend lines, obviously it's going to be different on linear and logarithmic, stuff like that. So really, in all honesty, supports and resistance aren't actual lines. They're actually zones. And so that's what I'm going to show you real quick. So when you look at this pivot, you could just draw a line across right here. But if you're looking at a long-term scale, like, hey, I'm going to take a swing trade, right? And I'm going to have this thing, I'm looking to hold this thing for 3 months, right? I'm not looking to buy something and sell it in 2 hours on a weekly. I want to get in on a supply or demand zone. Maybe I'm going short. I want to sell it at the supply zone. Or I want to get in a demand zone to go long and I'm going to hold it for a few months. It's really not a single line that you're going to be looking at. You're going to be looking at a zone to buy in, right? So like look at this area right here that we just drew a line a second ago. The way you're going to draw the demand zone off of this pivot is you would draw a channel. So obviously I need to make it straight. Excuse me for a second as I do that. Which isn't the easiest thing in the world to do on TradingView. So basically what you do is you go up from a peak or a pivot, and obviously when you get to these major pivots, you're going to have a stronger supply or demand zone. But basically, as you're running up, you grab a channel, you draw a channel from the peak down to where it bottomed, and then that's going to be your demand zone or your supply zone if it's overhead. So obviously if we're trading below this, this is going to be a supply zone or considered a break-even supply. And when you're trading in it, it's considered a demand zone. So look where we're at right now. We're in this demand zone. So if we do fall beneath it, which obviously look at that, the bottom's going to be that 140, 134 range. If we fall beneath this, the next spot we're going to be looking to catch support is going to be this last previous bottom because we pivoted off of it last time. So if we break 130, we could go significantly lower. Obviously the next support from there is actually not that much lower. It's only 128. But you're going to have this whole area right here be another demand zone. So anytime you have these pivots, you could draw a supply or demand zone. It's a demand zone when you're trading above it. It's a supply zone if you're below it. So if we were down here, this is going to end up being break-even supply. If it, obviously we could take a zone and draw the same thing up here off of all-time highs, and then that's going to be a supply zone. And the more times that you've gone into that zone and you failed, the stronger of a supply zone it's going to be. It's going to be harder to get through. So with all that being said, now we've looked at the supply and resistance and zones. I've got a bunch of stuff written down on this piece of paper as I'm going through it, so I'm going to make sure I'm just to cover everything. So now the second thing I want to cover is Fibonacci retracements and extensions. So this is a little bit of a level up from what we just talked about, the simple and supports and resistances. So I practice wave theory. Anybody who follows my charts know that. I do a lot of technical trading, even if it's not based upon wave theory, but generally I always try to have wave theory back up the trade that I'm taking. And if I really can't see wave theory or a count on a specific trade, I normally will not take it. That doesn't mean I won't. If there's very, very bullish flow on something, even if I cannot see the count, there are times that I will take it if I think it has good RR, which is risk reward. But for the most part, almost every trade, I make sure that I can count it via wave theory. So on AMD, what I have us in is that we're in a primary wave three, which makes sense. In wave theory terms, a wave three is going to end up being your strongest wave. So we're in a primary three, and what I have it as is that we just finished an intermediate three and that we're pulling down for our wave four. And I do think that wave four bomb is in. I could be right, I could be wrong, I don't know. But at this point in time, it's not important for this video. Let's look at these zones. So you grab this tool, this widget on TradingView. It's the Fibonacci retracement tool. So after we've already had this full wave three run up, and I'm saying, hey, that's wave three peak. Before I actually draw that, let me show you why I say that. So let's go with the Fibonacci extension. So Fibonacci extension tool from the bottom of where primary two ended up to the peak of intermediate wave one, down to the bottom of wave two, you can see it's a little bit off from where I draw it last time. You can see that we peaked right at the 161.8% extension. So what does that mean for us? Well, that's generally where wave three's peak. So because I've counted this as a wave one pullback for a two, if my count is correct, it's very possible that this is the wave three peak right here and that we're in this wave four, meaning we're going to go higher. But with all that being said, let's draw some support zones here with the Fibonacci retracement tool off of this entire move from primary two up to the peak of intermediate three so that we can see some zones to see if there's some levels that we can trade off of. Okay, so what you can see is that it kind of does respect them. As they're coming down, as we come down, we can hit this 14.6% retracement, kind of caught support right near it, came back through. We went through the 23.6% retracement, ultimately got back above it, but still there was too much selling pressure, so we broke back beneath it. Right here around the 38.2, we tried to gather some strength, ultimately broke through it, and then we started to create this trend line. So obviously this in the beginning when you're first pulling back, you're not going to have this trend line, but we caught some support right here in between the 38.2 and the 50% retracement. We bounced up. Obviously, we got rejected off another line that I've drawn as a trend line, and then we started heading lower. So you can see with the Fibonacci retracements, you will find areas of interest. It's not perfect, but it is a lot of times where some things will catch support and rally up. So that's another way that you can find areas of support and resistance is by using the Fibonacci retracements. And it's a little bit higher level than just drawing your standard line across the chart. So that's another way that you can look for supports and resistance. So that's Fibonacci's retracements and extensions, and that's what you do when you're looking for price targets in wave theories. You use those tools. Okay. So now that we've looked at that, if you're just looking at a standard chart and you don't want to just have to draw lines across where you see your pivots, there's an easier way that you can actually find supports and resistance. It's called the volume profile. So if you're on TradingView, you can see this right here. It's called VPVR, number of rows, 24 up, down 70, you type that into the indicators and put that on your favorites. And once you put it on your chart, you're going to, and then you turn the eye on so you can see it, you're going to see all these bars over here on the side of your chart. So what are these bars? Well, this is volume profile. So it's the amount of volume that's traded within this range, right? And then this red line is the point of control. So what does the red line tell us? Well, look at that. It's going to be, if you're above it, it's going to be strong support. And if you're below it, it's going to be strong resistance, right? It's going to be hard to get above it. So right now we're trading right on it. So if AMD does ultimately fail and go lower beneath this, it's going to take some strength to get back above it. But for now, we're kind of bouncing right on it. So how can we use these bars over here? Well, these bars can actually be, they could be supply and demand zones, or you can use them as, support and resistance. You could basically use this entire bar to draw a zone like that. You can kind of see, like, look at that. Wow. We just grabbed this one bar right here and just drew a channel based upon that bar. And you can kind of see, yeah, it does look like it goes a little bit higher, but you can see right here that this is a supply zone. And we basically failed right in it. So if we took these two bars right here, these two bars together could be a supply zone, and look what happened, right? Like, that's exactly where we failed. And you can come across and you can kind of see, oh wow, look at that. That's actually a spot where we struggled to get above. Eventually, we did get above it, but we struggled to get above it. And then once we did get above it, it became a demand zone. So right here, supply zone, it kind of rejected us. Then we got above it, and it became a demand zone and sent us higher. And then same thing here. Look at that. Wow, we fell into this volume profile, aka the demand zone. We bounced back above it, ultimately just to get flush with this waterfall right here, right through it. So that's another thing that you can use is you can look at these volume profile and you can say, hey, where's the support and resistance? The most beneficial thing about the volume profile are these gaps, right? Because there's a lot of different bars here. So when you see this, you're like, obviously this is going to be strong support or resistance. But when you get down here, you're going to be like, man, if we fall beneath right here, 132, there's a chance, obviously the next support's here at 130, and we fall from there, then 127. You can see basically all these bars. You can see the next areas of interest of where we potentially could find support. So that's how you use volume profile. It's a very powerful tool. A lot of people use it, and it's very simple because you just throw it on the chart and you can very easily see if there's these gaps. Another way you can use it in trading is if you fail here, it might be good to take some puts because it should freely move through this gap and it may not find support all the way down here. So if you're using wave theory or technical analysis and something tells you this chart's going to head lower and you see this gap, maybe what you do is, you set an alert right here at 133 and say, hey, I'm not going to take my trade till after we break this, or I'm not going to take my trade till after we break 132, because from here down, the volume profile, it should easily go all the way down here to 127, something in that range. So that's how you would use the volume profile. And apologize for not going over all this stuff in grave detail, but there's a lot of things to cover, and this has already been 12 minutes. So next thing, moving averages. On TradingView, I use what is the tool that's called EMA 8-21 plus SMA 5200. Well, why do I do that? Well, TradingView, even as a paid user, depending on what package you have, you might only get 5 indicators, and this is a way that you could throw 4 moving averages into one indicator, so I'd recommend getting it. Now, I'm on the hourly frame, and I just want to quickly talk about how I use this on the hourly frame to take swing trades. So what we can see here is that we have the red, which is the 8 EMA. We have the orange, which is the 21 EMA. We have the light blue, which is the 50, and then the dark blue, which is the 200. You can make these colors whatever you want. But the reason I want to show these is in real trading time, whether you're doing it on the daily for swings or whether you're looking at the hourly chart, if you're above it and you go down to fall down and touch the 50, like we got above it, we came down, we use it as support. So we broke above the 50 here, came back down, we touched the 50, and it caused us to rally higher. And then you see we came down, we almost kissed it, it caused us to bounce, and then ultimately waterfalled through it. Another way you can use these is when you get these crosses, right? So when you get the 821 cross to the downside, it's usually bearish, and you're going to see a waterfall move down. So right here, you can see the red crosses the orange. That's a bearish signal. We waterfall right through the 50. So if you see this bearish cross and then you see the 50 get broke on this hourly candle, which is a bearish engulfing, and it crashes down, you could take a short, a put, and you could just ride it down until it hits the 200 because that's the next area of support. So you can see how it worked on the bear side here. And then look at over here, right? So now that we had this entire sequence drawn out, one of the chart patterns that's very common is you'll see this falling wedge. It's kind of like a bull flagish type scenario here, and you could draw it once you have these pivots, right? So you could draw this wedge, and this is what made me take the trade earlier in the week, is I saw this wedge and I saw us break out, right? So let's zoom in on that. So hopefully this is clear for you guys. So what I saw when I tweet or typed into the Discord, what I saw was that it was looking like it wanted to break out. So we got, I think I put into the Discord right around here, as it got above it and it came back down. But based on the indicators that I was looking at, I think the MACD was curling up and there was some divergence on RSI. And we finally got above it and we got rejected at this 50-hour simple moving average. Well, this was a breakout, right? This is a breakout of the falling wedge, and then we got our retest. This is a back test. So if it would have failed, it would have sent us way lower, but it didn't. It held. And at the exact same time as we were getting our back test, these EMAs were bullish crossing. So it was a perfect entry to ride this thing up. Ultimately, it grabbed some strength. It blew right through the 50-day moving average. And where did it fail? Must be coincident. It failed exactly at the 200-day simple moving average. So if you were day trading this chart, I think it was Thursday or maybe Wednesday. No, it was Wednesday during FMOC. If you were day trading this, you would have grabbed it on this back test or on the breakout, or you'd go half position on the breakout, half position on the back test, and then you would be selling into the strength, right? As soon as you saw these candlesticks, you'd be holding until you hit up here. You get above the 200 simple moving average, and then you'd see this rejection and you'd be stopping out down here as you were trading this in real time. So that's how you would use these simple moving averages and EMA cluster. And now you can kind of see what's happening here. This thing could go lower, or maybe it holds and ends up going higher. But right now, not only did the volume profile show that the point of control is right here, but you can also see that, this moving average cluster is also right here. So there's pretty strong support right here. So we'll see where it'll go. We'll probably find out tomorrow, because there's probably going to either be a gap down or a crazy run up, knowing this market right now. So another thing to look at to say, like, okay, well, that's great. Like, it's got some moving average support, but in terms of wave theory, is there some support that we're looking at right here as well? Well, let's check that out. So I grabbed the retracement tool because I'm calling this wave 4 bottom. Not 100% sure if that's it, but I am favoring that. So if this is wave 4 bottom, then that would mean that this was an impulsive move to the upside, that this was a wave 1. So with that being said, let's go ahead and draw a retracement from the bottom to the top. My computer's obviously going a little bit slow here. And look what it's doing right now. So you can kind of see from this pivot low and what I'm thinking was an impulsive one up to the upside, that now we're in this corrective structure, and I do not think it's going to break this 130. So I could say, based on wave theory, that we're bullish above 130. If we break 130, obviously the low is not set for wave 4. And what are we doing right now? So we crashed all the way through all these retracements, which is common for a wave 2. We came down to the 61.8, we gapped beneath it, but then we quickly got back above it. So we were down here for 2 hours, because remember, on the hourly chart, and in that third hour, we got right back above it, and now we're kind of bouncing between the 50% retracement and the 61.8. So it could still head lower, but in terms of wave theory, it is favorable to say that either this was the bottom, or maybe we head back down and we cause a double bottom situation, and then we'd be in a wave 3. So this is a way that you could look at this pivot in terms of support and resistance. You could go ahead and draw lines. There's a lot of different tools you can use, but this is basically how I get my level. So I hope this did help. Obviously, this video went pretty long. If there's any specific questions based upon any of the rant I just went on, please feel free to drop a line, jump into the Discord, send me a message, and I will try to help where I can. All right, guys, have a good weekend. Hope you trade well this week.